Hello, my name is Doug Greenberg, and I'm the president of Pacific Northwest Advisory. This presentation covers changes made in the closed-end fund portfolio over the past couple days. To start the presentation, I wanted to just review a handful of economic indicators which are part of a group that I follow. And it points out that our economy is in a dichotomy of 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 the interest rate increases affecting a portion of the economy, but not the total economy. So, for instance, we're seeing manufacturing down, we're seeing consumer sentiment down, but we're continuing to see the housing market, despite higher interest rates or higher mortgage rates, continue to generate permits, starts, etc. And so I anticipate that today we will have another 75 basis point increase in the federal funds upper limit rate. And I also anticipate a 75 basis point increase in December. Um, Core inflation is still high and has been relatively unaffected until we get a new data by the increase in rates. Please keep in mind that it takes roughly 9 months for an interest rate change to ripple through the entire economy. I've said this a couple of times before, but if we started hiking rates in March, then December is when we'll feel the full force of it through the economy. And then hence January, February, March, et cetera, as we feel the effects of the hikes in April and May and June, et cetera. So to start with the portfolio, a slight change and an increase in the stock allocation, which was from the bond allocation. Again, a small amount. When we look at the regional exposure to the portfolio, again, reduced exposure to emerging markets and just increase that exposure to developed markets from the old portfolio to the new. And correspondingly, we again reduced Asia and increased the Americas. Stock style exposure has been a determining factor in return this year, where the large cap growth, mid cap growth sectors have underperformed the S&P 500, where the large cap, we have gone to an increase in both large cap value and mid cap value, and a correspondingly decrease in large cap growth. Large cap value has performed better and will continue as we slide into a slowdown or a recession. Um, on the sector side, I reduced exposure to the financial services. Although they printed some good numbers, I feel more confident in putting those dollars into more defensive sectors. That would be consumer defensive exposure, healthcare, and utilities. And given the decline in energy production, predominantly oil, I have increased the exposure to energy and decreased the exposure to the cyclical area. Real estate was another big one that was recently decreased as well. So, speak just briefly on fuel, gasoline. We are getting a number of indicators showing that there's a fuel tightness, especially in the East Coast. Crude, distillate, and gasoline inventories are a 4-year low. And as you might have heard in the on the news, diesel supply is very low as well. The concern becomes with oil prices is not only as OPEC cuts production, but when China reopens fully, whenever that occurs from their COVID policy, this will further impact fuel inventories and pricing. On the credit quality, I have kept it relatively the same. And you can see here we have a small bit in AAA, but the remainder is in triple B, double B, and B. To the fundamentals of the total portfolio, the distribution yield was reduced slightly This will also help reduce risk in the portfolio. The number of holdings were decreased by 1. The PE ratio, the weighted average PE ratio, was also reduced to 14.17, and which is below the S&P 500, which again provides us a further measure of risk reduction. And also, most importantly, when we look at the bond statistics, we can see we have a very low duration, and again, that portends to a lower risk. Please let me know if you have any questions, and I look forward to visiting with you soon. Thank you. Bye-bye.